With America in a transition period, Biden is tasked with reindustrializing America. With large macro and political headwinds calling for decarbonization, there lies great promise for the companies re-envisioning America's future. The companies building the mega projects changing the landscapes of our economy, and today we're going to be doing a deep dive into a company doing just that. Yo guys, Dead Prez here, and today the stock we're going over is Enbridge. Enbridge is one of the largest pipeline companies in North America with about 4 million customers. They serve and move about 30% of the crude oil in North America and 20% of the natural gas. Enbridge has been in consolidation on stock charts for about a decade, though they have been able to grow dividends and return some money to investors in that time. At a whopping 6.3% dividend yield, many might assume it's unsafe, but with over 40 diversified sources of cash flow and making 98% of money from contracts to use their pipelines, with those contracts averaging 25 years long, the stability is there. Pipelines are capital intensive. They must invest a lot back into the company. The DCF percentage at current prices is about 65%, leaving Enbridge with over 35% room to finance those new projects and increase dividend yield over the years to come. And that's assuming no growth. Here we can see Enbridge's footprint across North America, multiple oil pipelines and renewable energy infrastructure, as well as some solar projects popping up. Enbridge sold off its renewable sector years ago in an effort to focus on oil and gas, but now has gone back to its dive into renewables, a very lucrative industry in the decarbonization of North America. Taking a closer look at the Great Lakes region, we have the largest and busiest border for transports in North America. Enbridge has a stranglehold on southern Ontario and Michigan, both of which are key players and consumers of energy. Investors who are still fearing Michigan's Governor Whitmer's comments regarding Enbridge's Line 5 are overly worried. The shutdown of a pipeline of that magnitude would have such a negative domino effect that it's hard to believe any judge or even Canada would allow that to happen. A changing energy landscape in North America gives Enbridge stock some hidden value waiting to be tapped into. In the next 5 to 10 years, we will see renewables edge away at petroleum. Enbridge is ready and able to invest in vast mega projects that tend to please the government, especially in a political landscape that will benefit the companies putting billions into the renewable energy technology and infrastructure space. Enbridge also teamed up with companies in Canada on a carbon capture hub in Edmonton. Carbon capture technology is still not very popular, but will be. The more North America says it wants to clean the planet, the more money that they will have to spend on projects that will do just that. Enbridge tends to issue a lot of shares, then proceeds to cut them. These shares outstanding plateaus have happened before, such as 2004, where Enbridge was sitting at 2.7 billion shares outstanding for quite a while before they cut it down to 1.36 billion the very next year in 2005. We are on a current plateau of 2.07 billion, where no new shares have gotten added, leading me to assume they will ramp up buybacks and then cut those outstanding shares here soon in an effort to appreciate the price. Secured growth backlog is at $13 billion with capital to be deployed from now till 2026. What this means is that they have $13 billion worth of new projects that they are starting up or starting between now and 2026. Enbridge also announced at the start of the year they will be doing buybacks across both the Toronto Exchange and New York Stock Exchange. Not much analyst coverage on the stock, with only 3 buy ratings and 3 hold ratings. Combining all 6 analyst price targets, analysts are only expecting 6% returns in the next 12 months, which is just in line with the dividend yield of 6.3%. I'm expecting a greater return around 10 to 12% in the next 12 months, with better returns in the next 5 years. This is a long hold for me. You can see Enbridge has been on an uptrend since before 2020. Though the recent highs have been lost and red is appearing on the weekly chart, I wouldn't be too worried. So far, Enbridge has respected the 2020 high as a support level in its current uptrend. Any push or dive under would start to alarm us. As you can see by this weekly S&P chart, the whole market in general has been on a slowdown. Enbridge will get pulled down with the greater market, but the stock chart does not show you the 6% dividend yield. With just roughly $3,000 invested in Enbridge, you'll get a free share every quarter. I suggest a slow approach in current market conditions. The Fed is still raising rates and stocks are suffering. Buying the dip is smart, but not in lump sums. Timing a bottom is near impossible. Set aside some cash and buy Enbridge on big red days. Take advantage of others' fear and uncertainty. We'll be looking to add Enbridge in my next dividend account video, and that means we're going to have to replace or reduce one of my other positions, so stay tuned for that. And head over to my Instagram, guys. I'm doing a $250 giveaway, trying to give back to all my supporters. Link to my IG in the description of this video, and thanks for watching.